What if I told you that the difference between retiring wealthy and struggling financially comes down to decisions you make today? In the next 10 minutes, you're going to learn everything you need to know about investing, from absolute beginner to confident investor. And here's the best part: you don't need to be rich to start. If you're ready to take control of your financial future, smash that like button right now and subscribe so you never miss wealth-building content like this. Let's dive in. First, let's talk about why you need to invest. Imagine two friends, Sarah and Mike. Both earn $50,000 a year. Sarah keeps all her money in a savings account earning 0.5% interest. Mike invests 70% of his savings in a diversified portfolio. Fast forward 30 years. Sarah has saved about $200,000. Not bad, right? But here's the kicker. Mike has accumulated over $1.2 million. Same income, different strategy. That's the power of compound interest. Einstein called it the eighth wonder of the world. But there's another villain you need to know about: inflation. Every year your money loses purchasing power. That $100 today? In 20 years it might only buy what $70 buys now. Inflation averages about 3% annually, while the stock market has historically returned about 10%. You're not just growing your money, you're protecting it. Before you invest a single dollar, you need to understand three fundamental concepts: risk, return, and time horizon. Risk and return are like dance partners. They move together. Higher potential returns come with higher risk. Lower risk means lower returns. There's no free lunch in investing. A savings account? Super safe, but tiny returns. Cryptocurrency? Potentially massive returns, but you could lose everything. Your time horizon is how long you plan to invest before needing the money. Investing for retirement in 40 years? You can handle more risk because you have time to recover from market crashes. Need money in 2 years for a house? Stick with safer investments. Time is your superpower. And here's the golden rule that will protect you from disaster: diversification. Never put all your eggs in one basket. Spread your investments across different asset types, industries, and geographic regions. When one investment falls, others might rise. This is how you manage risk without sacrificing returns. Now let's explore your investment options. Think of this as a menu at a restaurant. You'll want to sample different dishes. First up, stocks. When you buy stock, you own a piece of a company. If Apple grows, your Apple stock grows. You make money two ways: the stock price increases or the company pays dividends. That's sharing profits with shareholders. Stocks are volatile. They bounce up and down, but historically deliver the best long-term returns. Next, bonds. These are basically loans. You lend money to a government or corporation and they pay you interest over time, then return your principal. Bonds are more stable than stocks, but offer lower returns. Think of them as the steady, reliable friend in your investment group. Real estate. Property can generate income through rent and appreciate in value. The downside? It requires significant capital up front, and you can't sell it quickly if you need cash. But real estate adds fantastic diversification. Here's where it gets exciting: index funds and ETFs, exchange-traded funds. Instead of picking individual stocks, you buy a basket containing hundreds or thousands of companies. An S&P 500 index fund? You own pieces of the 500 largest U.S. companies in one simple investment. Lower fees, instant diversification, and they often outperform professional investors. This is the secret weapon of smart investors: tax-advantaged accounts. These are absolute game changers, and every country has them. In the United States, you have 401ks and IRAs. In the UK, there are ISAs, individual savings accounts, and stocks and shares ISAs, where your investments grow completely tax-free. Canada has TFSAs and RRSPs. Australia has superannuation accounts. The specific names don't matter. What matters is this. These accounts let you invest without paying taxes on growth, or they give you tax deductions now. It's like the government is giving you a discount on investing. Many employer plans also offer free money through matching contributions. If your employer matches and you're not maxing that out, you're literally leaving money on the table. Here's your action step. Google tax-advantaged investment accounts plus your country name. Find out your limits and max them out first before investing in regular taxable accounts. This is the closest thing to a guaranteed return. Finally, cryptocurrency. Digital currencies like Bitcoin are extremely volatile and speculative. Some investors allocate a small percentage, maybe 5%, to crypto. But treat it like a casino, not your retirement plan. Only invest what you can afford to lose completely. All right, enough theory. Let's get practical. Here's your step-by-step action plan. Step 1. Build an emergency fund. Before investing anything, save 3 to 6 months of expenses in a high-yield savings account. This protects you from having to sell investments at the worst possible time. Step 2. Eliminate high-interest debt. If you're paying 18% on credit cards, that's guaranteed loss. Pay that off before investing. It's actually your best investment right now. Step 3. Define your goals. Retirement? House down payment? Your kids' education? Each goal has a different time horizon and risk tolerance. Write them down with specific dollar amounts and dates. Step 4. Choose your investment platform. For beginners, I recommend low-cost brokers like Vanguard, Fidelity, or Charles Schwab. They offer commission-free trades and excellent index funds. Apps like Robinhood are user-friendly, but do your research on fees. Step 5. Decide your asset allocation. A simple rule: subtract your age from 100. That's the percentage in stocks. If you're 30, put 70% in stocks, 30% in bonds. Younger investors can handle more risk because they have time to recover. Step 6. Automate everything. Set up automatic transfers from your paycheck directly into your investment accounts. Pay yourself first. You won't miss money you never see, and you'll invest consistently regardless of emotions or market conditions. Step 7. Stay the course. Markets will crash. You'll see your account drop 30, 40, even 50% sometimes. Successful investors do not panic sell. They keep investing, buying more shares when prices are low. Every market crash in history has been followed by recovery to new highs. Time in the market beats timing the market every single time. Let's talk about the mistakes that destroy wealth, so you can avoid them. Mistake number 1. Trying to time the market. Nobody, and I mean nobody, can consistently predict market movements. Day trading feels exciting, but studies show 90% of day traders lose money. Invest for the long term. Mistake number 2. Chasing hot tips. Your cousin's guaranteed stock pick? That's how people lose fortunes. Stick to your strategy, not the hype. Mistake number 3. Ignoring fees. A fund charging 2% annually versus 0.1%. Over 30 years, that difference can cost you hundreds of thousands of dollars. Low fees compound in your favor. Mistake number 4. Emotional investing. Fear and greed are your enemies. Create a plan, automate it, and stick to it regardless of emotions. And mistake number 5. Never rebalancing. Once a year, check your allocation. If stocks have grown too much, sell some and buy bonds. This forces you to sell high and buy low automatically. Here's the truth. Building wealth through investing isn't complicated, but it requires patience, discipline, and starting now. The best time to start investing was 20 years ago. The second best time is today. You now have the complete roadmap. You understand why to invest, what to invest in, how to get started, and what mistakes to avoid. Knowledge without action is worthless, so take that first step this week. If this video gave you clarity and confidence, show it by hitting that like button. It helps more people discover this content. And subscribe for more wealth-building strategies that actually work. Remember, every millionaire started with their first investment. Your journey begins now. Now stop watching and start investing. Your future is waiting.